Hey everybody, welcome to this webinar. This is Smoleny from Wolftrader Futures, and this is going to be a webinar today on the bear market. So welcome to the live stream here. I appreciate you guys coming out on a holiday weekend. This is kind of crazy, I know. It's going to be probably relatively short today, the webinar. I'm going to try to keep this under an hour. And I just wanted to talk about what was going on with this S&P and what this collapse that kind of came out of quote unquote nowhere, which I don't think was a big surprise to any of our subscribers, but to a lot of people it was. A lot of people did not see this coming or did not expect this, and we've been talking about the whole time how this was just nothing but a big bluff that the Fed was doing since really October, November. Most of the last 2 months, the Fed has been just pushing this and pushing this higher. And I was warning everybody because I think it's important to be warned about these things because these collapses can happen so fast. You can take back weeks and months at a time in bear markets in just a matter of days. So I'm just trying to get the word out to everybody about what's going on. Special thanks to Ron and Pat for moderating this live stream. I really appreciate you guys being out there and helping us out here and keeping this going on a weekly basis. So one of the things we try to do here on a weekly basis is we try to, uh, what's up, Al? Al's in the house. We try to keep a different topic each week. And this week I'm going to talk mainly about the S&P. I am going to go a little bit more into the portfolios too, because we are still talking about those. And I told you I was going to try to add at least one symbol a week on that. So if you guys need to reach me, you can reach me at Shane@wolftraderfutures.com. That's my email, or www.wolftraderfutures.com. There is a live chat feature there. You can go there. And on YouTube, you guys are here on YouTube. So Wolf Trader Futures is the actual name of this YouTube channel. If you like the video, go ahead and like and subscribe to the channel so you can get notified. On Twitter, you can reach us at WolfTraderFUT1. So I've been trying to post to that a lot more often just to kind of give the flavor and the vibe in terms of what's going on, because there is a certain vibe that we have throughout the day, depending on what we're looking at. But this week, the focus was really on, obviously, on what happened on Black Friday, that big collapse. We have multiple services here, many different newsletters: S&P, metals, energy, currency, cryptocurrencies, grains, and financials. That's probably going to be showing up as a service soon. I do have a separate closing bell on that. So if you're a gold subscriber, you have corn, you have the 10-year note, and you have the euro dollar. So those are already out if you're a gold member, but I'll probably add that as a service. So if you guys are interested in the bond, or you're interested in grains as a newsletter together, that's probably going to come out. So if you're interested, let me know, and we'll try to get you going with that. We have our Uranian newsletter where we talk about the astrology, and boy, is there a lot of astrology. There was a lot this month with that big eclipse that came across, the longest in 500 years. The market was supposed to fall after that. It did. Um, this stuff is important. We can't ignore the astrological factors. We look at the statistical runs going back through time, and there's a lot of astro events coming up in December too. So December's a big month, much bigger than November. And I think we're starting to see this now as we get to the end of November. So we'll talk about this in the Uranian letter. We'll talk about this in the S&P letter. But there are some really big events coming, negative, for the S&P in December. So keep that in mind. Stock ETF service, we have this going with our Fed juices and our double lunars, which we're starting. We have the so if you're a gold member, you get all of this. Platinum members get all of this plus the live Twitter feed. ETFs, trade services. We haven't done spreads in a few weeks, but we do some option spreads from time to time. The fast Fed big runs, which has really been taking off. That's going to be really our featured service here. And then the spreads, we're going to put together all of these different portfolios too. So that's what we have going on there. Disclaimer here, just real quick, this stuff is risky. Commodities are very risky. You can actually end up losing all of your money plus owing money with commodity futures. So it's really a risky deal. So be careful about protecting yourself using small position. I always like to say use small position sizes. There's micro contracts now. You can trade really small. Past performances are not necessarily indicative of future results. So even if a system is doing well, it can just kind of go to sleep for a few months and then come back. This is really meant to be an educational service to go with the book Trader's Guide to Financial Astrology. This is a book that I wrote with Larry Pesavento about the astro events and how they affect the markets. So if you're interested in that, go ahead and check that out. A Trader's Guide to Financial Astrology. It's really meant to be an introductory book just to kind of lay the groundwork. And then for those of you who are part of the service, especially the Platinum service, we talk about all of these planetary energies and what they mean. And it's pretty amazing how these things play out across time. I mean, they don't always play out, but the big events like we saw with the eclipse, and then I think the big ones coming in December are very important. Everybody gets the same data at the same time. Because this is a newsletter, I'm not managing any personal accounts as I do with my firm, Trading Ridge. This is really just everybody gets the same information because this is a newsletter. Warning about using fragments. Be careful about, you might hear one thing one week and then it could change in the middle of the week. So if you're just showing up each Saturday, we're happy to have you here. But keep in mind, there's a lot that goes on in between. So just keep that in mind. I don't have a service that's just one size fits all for the month. A lot happens with what's going on with the Fed throughout the week. Like this week, we started to see the Fed abandon the markets. We started to see, the tapers beginning. We started to see the Fed internals dropping. All of this happened during the week. And I was talking, and this is why I said on Wednesday, I thought we would see a collapse that would look like it came out of nowhere, but really it's not. There was just never anything there to begin with on this S&P. So yeah, we'll talk about that. This was what I call the great bluff. This was all just a bluff. The October November rally, that was there's nothing there. So we'll get to that. But the complete picture means that you have to look at each daily update that we do too. It's not just about week to week. So profit graph histories, this is terms of service. Everything that you see here is published data. I don't take back tests, hypothetical results. This is all published in the sense that everything that I'm putting into these portfolios is stuff that's been published to you guys. So I'm just kind of laying out what happened. In general, things are trending better each month because the technology gets better and we learn to optimize systems better and things like that. So everything's timestamped on Twitter. I know a lot of you don't like Twitter, but Twitter's got a lot of really positive features. One of them is that I can timestamp everything on an outline. You can go back and search through the history of these things. So everything that I'm telling you guys is it's always posted as it is. I don't share your personal data. I don't buy your personal data. I don't sell personal data. If you're on my email list, it's because you physically subscribed. And terms of service is really that you just understand the risk involved. So you can make a lot of money with this stuff, but you can also lose a lot of money. So you got to be careful about this, balance things out, and stay small. In crazy situations like the S&P, like even though I knew this was going to collapse, it's just it went for a long time before it did. But eventually these things do play out. But sometimes it takes time, and you need to give yourself time, and you need to have the proper uh, risk involved. Okay, whether that's a small position, whether that's buying small options, whether that's using tight stops, whatever it is, there's different ways to manage portfolio. You can do diversification, but you got to be careful about that. And that's the other thing too, guys. This is a newsletter. This is not me teaching people how to trade. Okay, that's not what the purpose of this is. I'm assuming most of you are relatively experienced traders. I think most people on the Platinum are. So I'm not sitting here trying to educate people on how to take trades. This is really education about the broader term cycles in terms of how the energies flow throughout the markets on the big picture. Okay, because everything that I look at is big term funds, larger funds. It's not, here's how you set up the trade and here's your limit, here's your stop. Sometimes we do that, like on the big runs, we do have stops and limits and targets and things like that. But some systems don't run with targets. Some systems do. Some systems run with really tight stops and targets, like our easy timers, really, really tight stops and targets. It just depends on the time frame. Okay, so news and events. User guide is on the website, continuing to add questions and answers. We do have the solar cycles up. Streaming crypto is here. Cardano's online. We have Fed juice, and we also have the daily statistics now. That's up for Cardano. So when I add a new symbol, I slowly add a little bit at a time. So we've added that to Cardano. We have the hottest cycles up. This is essentially what are the most we use a heat map to determine what are the hottest cycles running, and so we have it for S&P, gold, and Bitcoin, and so far they're all looking pretty good. They're all pretty much moving as they should. S&P was supposed to be heading down, and it is. Gold was down, making a short-term bottom, and then lower again. It is. Bitcoin generally negative. This was a quiet week for the fast Fed big runs. We took a lot of those profits early in the week, a lot of those big profits off the board, and so there wasn't too much going on. The problem with a holiday week is that when you have that holiday, sometimes the big runs, if it tries to exit on a holiday, it can screw up the whole signal. So I have to re-optimize it again after the holiday. That's the only weakness of the system because it'll tell you ahead of time when it wants to get out, and if it's trying to get out on a holiday, it screws everything up. So no big deal. I'll re-optimize that. Doing well. We had more oil trades. I think oil's like 10 out of 11 now. Maybe it's 11 out of 12. I got to go look at it, but doing very well. Okay, so we're adding more and more of these profit graphs. I will be getting these updated more, but I'm going to also put portfolios up. So I'll have like one symbol, like with the Fed use in the double lunar cycle. Okay, like if you traded both, what would it look like? That would be like if you traded them when they both agree, that kind of a thing. And then the bigger portfolios. Portfolio manager, we talked about this last week. I'll talk about it a little bit. But probably what's going to happen, we have pairs trades, right? So probably what's going to happen is I'm going to replace the pairs trades with the portfolio trades because I think it's a better deal just to put a portfolio together than to do the pairs trades because let's say you're trading corn and wheat and they're both supposed to be long in the portfolio, but if you're doing a pairs trade, one will be long, one will be short, and so you won't be able to get the maximum gain out of that. So I think we're just going to turn these into portfolios. So I think it's better off in the long run because a pairs trade is really there to reduce volatility, but if you have as many trading systems as we have, you can put them together and reduce the volatility that way. Newsletters out, November newsletters are out. Obviously, we're very close to December. That's coming out. There's a lot of astrological events coming up this month. Saturn, Uranus squares, Venus retrograde. There's all kinds of things happening, and the market tends to act certain ways around these. So it's a heavy month. December is a heavy month. It's not a light month. Normally December is with the holidays, but not this time. And I talked about that these seasonals aren't always positive, and we saw that on Friday. I mean, you can't just assume because it's a positive seasonal that it's going to happen. So the new closing bells, if you guys are a gold member, the grains financials, you can go over there and take a look at it. We have corn, 10-year note, and the euro dollar there. So you can go over there and take a look at that if you're a gold member. This will probably become a new service. So I'll probably have grains and financials. Once I get this added as a service, I'll probably have like corn and maybe another one like soybeans or corn and wheat. Just depends. Wheat is typically a very good symbol to trade in terms of signals, trading signals. It's just a little bit lighter volume, so it moves quicker. But you can trade these grains with smaller margins too, so there's some advantages there. And then the note and then the euro dollar too. So that's what that is. The fast Fed big runs. Right now we have S&P online, oil, gold, corn, Bitcoin. I talked for many weeks about this that I only wanted to take short trades on these because I could see the collapse coming. I could see it coming in the S&P. I could see it coming in oil. Oil and the S&P are following each other down. I talked very clearly about that oil is going to take the S&P down. You can't take down oil without taking down the S&P. They go together. This is the problem that the Fed has had. I think if they had their way, they would keep the S&P up and pull oil back. But oil is, that collapse was not new. I was talking about that every day in the market update. I said, oil's on the verge of collapse every day. So the energy subscribers knew this about oil. This was not a surprise. Now, I'm going to talk a little bit about the portfolio analyzer. For those of you who weren't here last week, the whole concept of what we do, we have many different trading systems, and we're going to put them together into a portfolio. There's going to be many different portfolios. So it could be like portfolio 1, portfolio 2, portfolio 3. And basically what that means is that if you combine different symbols together, this is what it would look like. So different trading systems, this is what it would look like. So a portfolio, most people think of a portfolio like I'm just long a bunch of stocks. This portfolio is a little different because you're following trading signals. They may last from 2 days to 2 weeks or a month. but you're always in, and they're long and short. It's not always long, it's not always short. When you combine them, you tend to get a much smoother curve. Now, there's no targets or stops on these because they always have to be in, because they always have to be hedging against each other. So if you're in a system and you hit a stop, let's say you're in 10 different trading systems and 5 of them stop out, and then you only got 5 on, well, now those other 5 can't hedge. And so the problem is, a lot of times when systems, right when they're doing their worst, that's when they turn around and start to do better. So this is why it's important to leave them alone. Just don't mess with it. Just let it go do its thing. The more that you add, the more you trade small, you diversify. That's the risk. And so this is the strategy to reduce risk with this. Again, like I said, there's other systems that we have. The Easy Timer has really tight stops and limits. The Big Runs has wider stops and targets. We do trail that sometimes. This is just to look at everything as a whole, and the whole is greater than the parts. So I want you to think of that as a whole. So this was an example. I'm going to go quickly through this. So last week we talked about this. If you combined the different metals, copper, silver, gold, you would get different profit curves. So for example, copper looks like this. We started tracking the Fed use about a year and a half ago on different symbols. It took me a while to figure out how to do this with other symbols. The S&P is a lot more straightforward because that's what they're targeting, but it does affect other markets, what the Fed is doing. So I was working on figuring out, how does the Fed affect copper? How does the Fed affect silver? How does the Fed affect gold? And because the Fed is such a big player, it affects these other markets. And so we have trading systems based upon what the Fed is doing. So this is the Fed juice. It's a neural network between what the Fed is doing. So copper doesn't look so impressive, right? Because it had this first year where it just kind of it was negative, and then it takes off here. Silver was kind of the opposite. Silver went up in the beginning and then went sideways, and then gold has been the most consistent of all. These are long and short trades, long and short, every trade. So it's not like the market was just going up and we just went long. Like that could be, it could be a very good strategy at times, like if you're just trying to buy crypto and hold it or something like that. But I'm more interested in long short trades all the time. Every trade is either switching long or short. So it doesn't matter what the market is doing. It doesn't matter if the market's going up, going down, going sideways. So when you combine these together, you get a much smoother looking profit curve. That's a quarterly, and then you can go into monthly, weekly, and that's what it looks like daily. Now, those are just the Fed juices. We have dollar juice, we have double lunar cycle, but we can get very detailed statistics. So you're going to start to see this show up. If you're a subscriber, you'll start to see, okay, here's the Fed juice portfolio for copper, gold, silver, etc. This is what it looks like if you put together some of these double lunar cycles. This is the S&P here. You can see it's generally trending up. It has this big pullback here, but then it continues to go up. Here's your S&P double lunar cycle daily. So this one here is, sorry, that's the one we just saw. This is the Bitcoin double lunar cycle here. And this one, excuse me one second here, I'm just looking over. I'm looking over at the recent double lunar cycle S&P here. This one here, generally trending up, did not have too much pullback. I just want to point out too, the S&P double lunar cycle did catch the big collapse in the S&P. I was just verifying that right now. So that's not even on this graph. The S&P double lunar was short into Friday. It went long at the close on 11/26. So this would have shot up even more. This is a little bit dated, these graphs, but I'll get those updated. 10-year double lunar cycle has a dip and goes up. But again, the idea is that when you combine these together, you get a much smoother curve. And so what we're going to keep doing here is we're going to keep combining these different systems together to get very smooth curves on these portfolios. And so this is not cloak and dagger trading. Cloak and dagger trading, to me, that's just kind of like, here's my entry, here's my target, here's my stop, trail it up, and it's cloak and dagger. You're kind of playing around with it, and we do that on the big runs. I mean, I get in there and I trail the stops down, and whatever. It's kind of like call that Houdini trading, where you're trailing the stops. This is not that. This is not cloak and dagger. This is just, you're always trading all the signals all the time to create a portfolio. So it's kind of boring, but it rises across time based upon what it's done in the past. And again, these are published results, guys. This is published. This is not a back test. This is what I published to subscribers. And then again, here are the statistics you can look at. So we're working on this. I'm working on also creating a way to do this with ETFs. So for example, this is S&P, Bitcoin, and the 10-year note. Again, this could be the SPY, the Bitcoin, the ETF that came out, and the TLT. So we could combine this. I'm working on it. It takes time, guys, to collect all this data. So that's why I said each week I'm trying to come with a new one. Uh, this is what it would look like. This is a new one, a new portfolio. If you put together 10-year Bitcoin, S&P, and the double lunar cycle, and then you also put together gold, silver, copper, and the Fed use. Now, there's different ways you can do this. You might have to have two different sub accounts to do this because they could trade against each other if you have the same symbol. But in this case, they are different. But if you just put, these are all different symbols, so you could do it. But here's what it would look like. This is what it looks like across time if you just throw it all together. So you see the more symbols you add, the smoother and smoother and smoother the curve gets. And again, this is not cloak and dagger trading where you're like looking and plotting and here's the pullback and here's my limit and here's my stop and here's my target. It's not that. It's just you're just always trading the signals all the time. It's kind of boring. But my whole focus is on larger portfolios across time that hedge out and create smooth profit curves. And then you'll also see that there's sometimes there's a place here where it runs flat. Well, this is where the technology also improves on the optimizations. So as our technology gets better, these get better. Here's Bitcoin. So I have Bitcoin with the Fed juice and the double lunar cycle. Now, Bitcoin started out a little bit rough with the Fed juice because you have limited data. And typically on these Fed juices, I need about 10 years of data. We don't have that on Bitcoin. So in the beginning, it started out a little rough, but now it's starting to smooth out. You'll see here, this is what it looks like. If you combine Bitcoin, this is the Bitcoin Fed juice. This is with the double lunar cycle. You can see it starts to take off here. So as we get more data, as we get the double lunar cycle involved with the Fed use, you start to see things are starting to really streamline here, and that's what we want. So, I mean, these things aren't perfect across time. Like I said, the Bitcoin starts out a little rough here because we have limited back history, but as we get better with the technology, I learned to optimize this across a smaller sample. So, if I look at 100 days in the past with other symbols or 200 days, I look at smaller samples of Bitcoin, only like 50 days, 40 days. And by doing that, I don't need as much back history, and then the curves start to look better. But okay, these are just some examples. Each week, I promised you, I'm going to come with a new symbol. So this week, it was Bitcoin. We put those together. That's with the Fed juice and the double lunar. So you are ahead. This is a micro contract. It's ahead about $17,000. But again, that's not without drawdown. I mean, it had a $12,000 drawdown here too. But again, the point of this is to put all of these together and to create a streamlined portfolio. And then these micro contracts, they're not equally weighted. Like for some reason, some of them, one micro contract is heavily weighted, whereas another one isn't. Like gold isn't as weighted, so you got to do twice the gold and things like that. But anyway, okay, so let's talk about our S&P. All right, S&P. Here's what I've been saying all along, and I know people get upset about this, but here's what it is, guys, okay? And I'm basing this off of watching what the Fed does. We're in a bear market. We've been in a bear market since July the 6th, based upon what the Fed is doing. This is a slide that I put up on Larry Pesavento's show on 11/24. Again, this is based upon the evidence, what I consider the evidence. It's not an opinion, it's not earnings, it's not whatever, it's not GDP. It's based upon what I'm looking at, what's going on with the Fed. So I call this evidence. This is the only thing that matters to me. I tune all the noise out. The short-term bluff from October is over. I said that very clearly. This market had run up. It's over. The Fed taper is here, and I think that will take a cumulative chokehold on the market. I think this is going to be cumulative. It's going to get worse and worse each month. And these internals are sinking. This is what I said before the collapse on Friday. Now, since we're in a bear market, the selling is swift and decisive. Bull markets don't see that kind of selling that we saw on Friday, right? So this is the biggest statement that I said because the price, I'll get out of the way so you can read this. But essentially it says here that since we're making this such a strong negative divergence here, that the sinking Fed internals will make it appear as if the selling comes out of nowhere. And that's exactly what we saw on Friday. All right. So this wasn't a surprise to me. It wasn't a surprise to our subscribers. But a lot of people don't want to believe it. They get really upset. They feel that earnings are only thing that matters, and the trend is up, and the holidays, and this and that. And again, I said, look, usually the Fed has the upper hand in the holidays, but that doesn't mean it has to happen that way. We've seen it before where the holidays have been negative, like in 2018. So, and again, we're repeating the 2018 pattern, and I said that that could show up again. So, not a big surprise there. If we come over here, this is what I call the great market bluff. Now I got two graphs to show you here. This is the first one here. This is the S&P. Zoom this down so you can see. Okay, there we go. So this is where the Fed really creates this bluff where they were trying to make it appear as if everything was fine. Um, you know, they were trying to essentially save the market here and show everyone that there was nothing wrong. Everything was fine. This low was completely normal. The market did it itself. It didn't do it itself. And in fact, the Fed had to overcome a lot to get it up. They had to overcome two banking holidays down here. And the thing that I was talking about with the internals falling is that you had this big divergence here. I mean, this was huge, falling, falling, and falling as the taper is starting now. I saw this happening and I said, look, this is going to create selling that comes out of nowhere. And that's exactly what we got here. It was the worst day of the year, the most unexpected time. Now, this is the thing about bear markets, that you don't know when the selling is going to come. You just have to be short. And it's crazy. Like it will find a way to catch you off guard. So be careful about this. The bear markets, nobody expected it on Friday. It caught everybody off guard. The point is, my contention was, we said it was going to collapse. I was very clear about that. I felt very clear that this was going to go down, and it did. It just, you don't know when it's going to happen. Like, you just know that these divergences are forming. So anyway, okay. Any questions? No. Okay. Hey Gary, what's up? Gary's in the chat. And so here's another view. Now let me show you the difference between these two. This is really telling here. This is the Fed internals if you take into account the banking holidays. So every time there's a banking holiday, these things go to zero. And the Fed has to sit there and frantically scramble to try to come back and make up for the banking holiday. So they do all of this stuff behind the scenes. And now notice this, and I'm going to show you the next slide, is as if you don't take into account the banking holidays. And you'll see very clearly here. You see this here? This is all the Fed pushing the market back up. You see this here? Okay, and then it starts to come down. There's another, it comes down into here. Next banking holiday comes up. And now you start to see this really big collapse into here. So this is really the whole picture here. If you see it without the banking holidays, you can really start to understand and appreciate what's going on here. Of course, there were banking holidays, but I mean, and we saw the market essentially stop every time there was a banking holiday. But you can see here that there's a very big collapse going on here. And, that to me, that's an obvious sign. I mean, that's what I follow. That's why I do what I do. And so a lot of people have looked at this market for many years. I mean, there's very, very experienced and seasoned investors and traders, and everybody's got different ways to look at the market. And a lot of people have had a lot of success with this. But all that I'm saying is that if you have looked at the market from, the 40s, 50s, 60s, 70s, 80s, 90s, 2000s, this is a totally different new phenomenon that you've never seen before in terms of the Fed. And so this is what I track. This is what I track. I track the evidence. I track the data. So it's not that it's wrong to look at it other ways or to look at fundamentals. I believe in fundamentals. I'm not stuck in one viewpoint. I know a lot of people get stuck in one viewpoint. Like people that do just astrology, they think that astrology can describe everything in the markets. It can't. It can't. I don't fall into that trap. That's a trap. If you think that astrology can forecast everything, you're gonna have some issues. You need to look at the totality, the whole picture. And so what's going on with the Fed is a very real thing. This is very real data. And I say this to people. For the market to go down, we don't need some big astrological event or a cycle or anything like that. You just need the Fed to pull back, and that's what they're doing, and that's why the market started pulling back. So this is a dominant feature. I try to balance it out with the Astros, so that's what's going on. But you can see it so clearly here when you take out the banking holidays that this is what's going on, and the market's following it once again. It always follows what the Fed does. There hasn't been one situation where the market goes against the Fed, where the Fed's pulling back and the market just starts rallying up. It just doesn't do it. No, not since 2009. And so it's certainly not now with the market still vulnerable. I mean, we're not that far away from COVID, guys, from the world shutting down. The market's still in a pretty fragile place. The Fed taper is here. They are starting the taper. So again, this is a cumulative effect. It's going to continue to build and build and build upon itself. And 15 billion a month as you get into the second and the third month, the market's really going to start to feel this. And we already started to see it last Friday. And again, December is a heavy month from the transits and the astrological standpoint. The lunar eclipse, we talked about this, that the lunar eclipse, the market tends to be an attractor before the eclipse, and it tends to be negative after the eclipse. And that's pretty much what happened with the markets. This was the eclipse. The market goes up. Now, what's fitting about this eclipse, I think the symbolic nature of this is that it was such a massive eclipse in terms of the length of it, most in 500 years. Wouldn't that be a fitting top to the stock market? I mean, I think that's a pretty symbolic gesture if you're looking at this. This is also a very dependable uh, astrological indicator. So we put this out to subscribers too. We said, look, on the 19th, it's making this peak and it's supposed to keep falling all week. And it did. It overrode the positive seasonals. We did get some rally back on Wednesday, but again, I didn't feel that was I didn't feel like that was going to hold very much. So this is an example of the hottest cycle into here. So just to give you an idea here, how this looks. So I take the hottest cycle, and I just kind of give people a basic roadmap of that. So we have that for different symbols. We have that for S&P. We have it for gold, and we have it for Bitcoin. So, all right. So very quickly, I'm going to go over some other markets here. So I know a lot of people have questions about other markets. So first of all is gold. So I do want to point out here that gold has been in a negative seasonal here on the solar cycle. That's essentially following this. You can see down here too, the double lunar cycle here is pulling back down here, and the market pulls back exactly with the double lunar cycle right there. So you see that right there. So let me draw this so you can see it. So here's your double lunar cycle here, and here's the market, and here's the double lunar cycle. You can see that these follow each other pretty much to the T here. So the double lunar cycles have been very good about this. So this is still showing gold maybe at a short-term low. Gold did hold up a little bit with that big decline. It held up better than Bitcoin. Gold and the bonds tended to hold up a little better, but we're still in some negative seasonals here. I'm a little bit worried about all markets right now. I think in the beginning, when you have a financial shock, all the markets can fall together, and then eventually they will start to diverge and go in different directions. But we were pretty good about this. We had some good calls on this. The gold miners has been one of the best performing Fed uses, and that's available in the stock ETF service. This is available in the metal service, but it caught the double lunar cycle catches this. We may be at a short-term low right now with gold, but there could still be some more downside with this. And again, I give more specific turning points with the metals newsletter, but I feel like this has been modeling this pretty well. We had this decline here with the seasonals, also the double lunar cycle. And when two of these different systems agree, you tend to get better movements here with the markets. Now, oil, I'll get into that real quick. Oil is, this is a market that we have been calling a collapse for a while. Every time I give a market update, I talk about how oil is on the verge of a collapse. And it did, and I feel very strongly about this, that oil was going to take the S&P lower. They're going to move together. They're intricately tied, and the Fed juice has been just unbelievable on this. The Fed juice, just the Fed juice alone. If you go back here, you can see here it goes into this around 914, somewhere around there, around 914. It goes into this buy. It catches this big move up here. It has a little bit of a wobble, but it's been in a sell since 11.3, and it's been catching this whole move down. So I put every day in the update, look, oil's on the verge of collapse. Oil's on the verge of collapse. This is a bear market. It's a bear market in oil. It's a bear market in the S&P. Both these are going down. So originally when they tapped the strategic oil reserve, it did rally up for a day, but that didn't change the Fed use, and it didn't change the fact that the S&P and oil are tied together, at least in the beginning. I mean, I think obviously at some point they're going to diverge, but the news about the new COVID variant, all of this stuff going on, that's going to drive demand down. If there's lockdowns, that's going to drive demand down. Releasing the reserves, that does have some effect, a small effect. But I think the bigger thing here is that as the intraday moved back and forth on the fast Fed big runs, which is what I looked at, uh, it moved with the S&P almost lockstep. I was watching those two. Oil and S&P tend to be locked right now. So I feel very strongly about these two, that this and S&P are going to go together. So that's just what it is. Natural gas tends to be, I don't know, a lot of people don't know this, but natural gas tends to be a contrarian play to the S&P. If you look at the weekly chart of natural gas runs opposite of S&P. It just does. For whatever reason, I mean, we can talk about supply demand and shutting down pipelines and Europe and Russia and all of this stuff. But the point is, on a bigger scale, when you're talking about flight to quality, right now the flight, it was somewhat to gold, not really. It was going to the bond and it was going to natural gas. Okay, so that's right now, that's where it is. Now, if you get a big panic, everything could go together, which I think still has the risk of doing. I still think gold could see lower prices before it goes higher, but oil is the big problem, obviously, right? So we've been pounding on this, and this is why I said no long trades on any of this stuff. I was sending out warnings about this. I'm like, they're all going to go down. Like and this was when everything was going up and everyone was all happy, and the sentiment was pushing up near 90%. And what are you talking about? It's a bull market. It's like, no, it's not a bull market. If you go back and look, there's nothing there. And so this is the core of everything. There's literally nothing there. And I put in the S&P newsletter, I put like, this is weekend at Bernie's. Like literally, this is weekend at the S&P is weekend at Bernie's. There's nothing there. Okay, so and the fact that we have a taper now, it makes it tough for the S&P. 10-year note, we did see some flight to the 10-year note. But in general, this is a really interesting situation because you've got the Fed essentially long all of these bonds, and the Fed use still is still in a sell on this. And by the way, this symbol, the 10-year note, the Fed use has modeled this just very well. And also these little double lunar cycles have modeled this extremely well too. This is one of our best performing double lunar cycles. So this is available in the gold service. So if you want to take advantage of the 10-year note, I'm going to put together the Fed juice for the 10-year note also with the double lunar cycle. So just to clarify here, just to clarify what we're looking at here, these green arrows here that you see on the chart, I'll do it in green so you can see it. This is the double optimized lunar cycle. These are given out at the beginning of the month, each month. Okay, so this is kind of like a predestined trade. Believe it or not, I know it looks crazy. How could that possibly be? Well, we have an optimization method that we use 3 different layers to get this down. And then you have the Fed use here, which is the one here in like 11.1 here. This has been down for most of the time here. It's still down here. Okay, so put those together, you get some pretty powerful looking profit graphs on that. But people did run to the bond initially. But if you get a big sell-off, I mean, they could all go down together. It's pretty hard. It's pretty hard to know which one will come out first. But gold looked okay. The bond looked okay. Natural gas looked okay. These little green arrows, this is what it looks like if you put the profit graphs on. This is the history of the double lunar cycle. So these little green arrows on the chart here. And you get these at the beginning of the month each month. So if you're a subscriber, you get these in the newsletter. Or if you're a gold member, you go to the website and you can see them. They're all there. This is all predetermined. The red arrows are not as much. This is the Fed juice into here. Yeah. So that's what's going on there with the bond. Let me read. I'm going to read some questions here. The oil reserves was a joke, in my opinion, contributed to 50 million barrels. The world uses 100 million a day. Yeah. I mean, it was a symbolic gesture. The oil reserves, yeah, it was a symbolic gesture. Obviously, COVID is a much stronger deflationary force than that is. So, unfortunately, look, it's not good for the S&P to go down. It's not good for anybody. It's not good for the economy, the global economy, the U.S. economy. There's a lot of people with a lot of things writing on the success of the U.S. markets. It's just right now with the inflation, the Fed has to pull back, and look, man, there's some point to where they can't, the market at some point has to be able to do it on its own. The Fed can't save the day every day. The Fed can't always have to be the one that has to bail everyone out. At some point, the markets have to be able to go up on their own, and so it's some, I mean, like people get mad at the Fed, but look at what they did here. I mean, they were able to drive this off. They drove the market off the lows here, off these September lows. When we got down to that 4,300, they drove it all the way back up here. Okay, so I mean, people can get pissed off at the Fed, but they're trying to help the market out here. They're trying to they're trying to help out the market. The problem is, at some point, guys, the market has to be able to do it on its own, and so we need to find that balance between the Fed and the market's doing it on its own. And right now, we don't have that balance. We have a market that cannot do anything on its own without the Fed. It's really kind of sad. So eventually these things will level out, but right now that's not what we have. Bitcoin and Cardano. So first of all, crypto is not looking so good right now. We're starting to see where everybody's convictions are, and clearly they weren't with crypto on Friday. And so we are approaching a seasonal high on crypto, and I'm kind of holding out here with a lot of these future forecasts here because this is for subscribers. But we're going to find out where everybody's conviction is, because if they really feel as strongly about Bitcoin as they say, they're going to run to it. And we didn't see that on Friday, and we started to see everything shift back into a sell again on crypto. So I'm very concerned about crypto right now, to be honest with you. We're coming into a seasonal peak. We have Fed use sell, we have double lunar sell, and we have a market that's entering a very turbulent December. So I don't put this on my list right now of my favorites in terms of flight to quality. Like I said, right now it looks like it's natural gas, bond, and gold. But I think gold still could see, gold and the bond kind of have a similar track where they kind of track down into the December area and then they kind of take off. So gold might see another leg down. I give the specific turning dates to the subscribers, but the Bitcoin, I don't know, man. I'm a little concerned about it. But if you're just following the long and short signals of Bitcoin, if we go back here to the chart, these again, just to kind of link this in your head, when you see these arrows here, these buy and these sell arrows here, you can't see it there. I'm going to circle it in yellow. These buy and these sell arrows here, this is the double lunar cycle. This is given to you at the beginning of every month. If you're a crypto subscriber, you guys get these signals every month in the newsletter. It shows up every month in your newsletter. Believe it or not. I know it's hard to believe, but it's all published, guys. This is what it is. And this is the profit curve of the Bitcoin, the double lunar cycle. So if you just follow that, this is what you've done. This is up $17,000 on one micro contract since the inception here. Okay, so that's the Bitcoin. Now, again, this is not without drawdown. So this is where it gets into risk and measuring out and how much do you want to put on, or do you want to do options? Do you want to trade ETFs or whatever you want to do with this? But they're having success. The double lunar cycles are having success here. Corn, I'll talk very briefly about corn. Corn has been very successful with the Fed juice. I'll take a look here. This is interesting. Corn is interesting. It's coming into some type of a seasonal surge pattern. So that's kind of been like a tug of war between what's going on with the COVID situation right now and this. But the Fed juices have been tracking this beautifully. You can see just the Fed juice alone here. I'll probably have this next week for you guys to see how corn is doing. But 10.5, it goes up. It's been in a buy ever since on the Fed juice. And then if you take a look on the double lunar cycles, you can see here, I'll do this in a different color so you can see here. The double lunar cycles have also been catching these moves too. And again, guys, you have all of these double lunar cycles at your disposal. You can put these together, and I'm going to put these together in a portfolio for you guys too, so you can just say, if I traded all of them, how would it do? Okay. But corn's been trading beautifully with the Fed juice also. It's kind of like doing its own thing right now. It's in a positive seasonal right now for the next, few weeks, couple months, because there's, it's a strong seasonal pattern with corn. So probably one of the strongest seasonal patterns that we have. Okay. All right, bank relative strength. So this is one I've been talking about too. So the whole focus of what we're talking about here, let's just kind of try to tie all this in together in terms of what I think is going on here. I do believe that we're in a bear market on the S&P. You can see this is trending lower from here. Now, the reason I'm showing other markets right now, this is the S&P, but I do believe this is trending lower across time, and this is why I talked about that collapse coming on the S&P. That is, to me, as far as I'm concerned, that's a fact. I'm looking at data. Again, most people say, well, the bear market's got to be down X percent, 15%, 20, whatever it is, 20%. I don't look at that. I look at the way that I look at it. I look at what's going on with the Fed because I know the market can't do anything without the Fed. And I know if there's a taper coming and I'm looking at these internals sinking, I know that the market's got, at some point, it's got to start to follow it. Okay. So why do we care about other markets? Well, we care about other markets because gold and the S&P and S&P and oil, there's so many markets here. S&P and oil have been moving together. And so this is why I feel very strongly about this, that the S&P and oil are going to share a similar fate here. A lot of this might be due to demand issues and things like that. But the point is, we've been talking about this for months, that these two are tied together. And so it's a huge risk right now. I do think crypto's at risk too. I think this is also tied. I think it's tied to the oil S&P trade. But the other things that we got to look at too, are gold going to hold up? So far, is gold going to hold up? So far it did. Is the 10-year note going to hold up? So far it did. So there's always going to be winners and losers to this, but I think the main danger here is that the S&P is going to have effects on other markets too, not just itself. It doesn't exist in a bubble. So that's where we're going with that. And banking relative strength index. So this one is important because I think the banks are a leading indicator to the economy. They're a leading indicator to the stock market. You can see here that this is a relative strength index of the banks, and this has been declining. So this has been going down since probably late October. This has been falling. So this is the S&P here. I know you can't see it, but this is the S&P here. S&P has been was going up while the banking sector was going down. And so this was creating a negative divergence with the banking sector. So this is not good. So this, to me, this is related to the taper. There was a brief spike up here on the news of the Fed chair appointment because Brainerd wasn't going to be on some oversight committee of the banks. So they temporarily got excited. But the overall trend of the banking sector is lower now to the S&P 500, and that's not a good sign either. And so I've been talking about these internal, like there's all this stuff going on behind the scenes. I think many people have pointed out that the breadth of the market has been horrible. 2/3 of the stocks, the issues on the S&P are trending lower. Yes, there are some big names that still have some very good earnings. I know Apple still does, Tesla, all these other big names. But the problem is when you have a large majority of these small, mid cap, small cap stocks trending lower, it's not good. You want to see a broad-based participation. And I know there's rotation out of these different sectors at the end of the year, and they're trying to rotate. But the problem is the market's very sick on many different levels when you look at this. And so we can just look at a few companies and a few earnings and say everything's great, but it's not. That's a fundamental viewpoint. I know a lot of people focus just on that. But again, at the end of the day, it all comes back to this. This is what controls everything. And keep in mind, guys, that if the market falls, the earnings will fall. Okay, so if the Fed starts to pull back and the market starts to decline, all of that, it's a feedback loop, guys. It's a positive feedback loop where it can start to have a snowball effect on other things too. One last thing I do want to point out here is the VIXY. So this is one of the symbols that we talk about in the stock ETF service. And so I had been beating on this drum for a while. I was talking about the fact that we had this big positive divergence forming here. So you can see here, this is before we had the big move on Friday, but I said, look, the RSI divergence is spiking here. There's a very, very strong chance this volatility is going to shoot up here based upon what's going on. And also the Fed use has stayed into this buy the whole time. The Fed use, let me point this out to people too. Sometimes the Fed use will stay in a signal for a long period of time because it doesn't like a signal. It didn't get faked out in many other situations here. And this is one here too. It's said to stay long this whole time. It said that this is not a real decline in the VIX. And so if we go fast forward here to what happened on the next day, you can see this is the big spike up here in the VIXY. So again, it was telling you something's wrong. So just because sometimes the Fed use stays in a signal for a while and you don't understand what that means, sometimes it will play out. So you can see this that this is still on the way up, and there's still potential for this to move higher here. Now there is a gap. It did leave a gap. The VIX does like to leave gaps, but the point is this positive divergence caught this in the recent market advance. So I believe that we are in a bear market right now. I think that until the market can come back into balance and start to do things on its own, and until the Fed's pulling back on this taper right now, that's going to be tightening monetary policy. I still think that we're going to have headwinds going forward on the S&P 500. And my main thing about everybody is I want everybody just to be careful here because there is a lot of resistance to going to cash or just being safe because people don't want to miss out and all of this stuff. But just keep in mind that when the market collapses, guys, these collapses can take back in a matter of days, months of advances, weeks and months of advances. So be very careful about this. Again, I feel very strongly there is still a big negative cross current on this market. I still feel like we're in a bear market. And until I see these Fed internals start to flatten out and raise again, I still have to stick with that call on the S&P, guys. So that's basically where we stand right now. So Q&A real quick here. You can get, how do you get notified of the webinars? You can subscribe to the YouTube channel here, click the bell notification, or you can go to Twitter. So I highly recommend you head on over here to the @Wolftrader FUTU1, subscribe to that because we give updates in the day. There's an email list here. Wolftrader Futures, you can go there, you get emails, or on the S&P closing bell, I tend to put the link there for you guys to check that out. So just a couple things here. If you sign up for the free trial, people ask me this all the time, how do I sign up for the free trial? You have to go on and create an account on the website and then a PayPal profile. It doesn't charge you until a week passes. So it's not like you're charged and you're refunded. You just don't get charged until a week goes by. And then this way it gives you the permissions and the rights to go throughout the site. So if you want to do that, that's how you do it. You just go there. And then PayPal is I find is very good for what I do. So a lot of times people ask me, with all these indicators, where do you start? There's so many indicators. So the first thing that I would tell people is that the double lunar cycle is a good place to start here. And now that we have these portfolios, you can combine the best systems. So just to kind of go back here, just to show you an example here again, on the charts here, when you see these green arrows, this is the double lunar cycle. You have these at the beginning of the month. This is the profit graph of the 10-year note on the double lunar cycle. But we can also put these together in portfolios. So for example, we talked about this before. If you go back here and you looked at the 10-year note, Bitcoin, the S&P on the double lunar cycle, and then gold, silver, and copper on the Fed use, and you put them together into one portfolio, this is what you have. So you start to get a much smoother curve. So I would recommend starting with the double lunar cycle. It's very simple. You know what it is at the beginning of the month. And then you can combine these into a portfolio, and it's a pretty easy thing to do. I mean, it's just the signals come once every few days, and it's not a cloak and dagger, target limit, that type of a thing. Also, a lot of people say that they're not traders. They're not traders, that they just invest. I would ask you to reconsider that simply because uh, it's been very easy, guys, the whole time since the Fed has been in there. It's been very easy to just put your money in the market and be passive. Well, guess what? If the market doesn't go up all the time, that's not such a smart strategy. If the market's going to start falling and falling and falling, you can buy better stocks, but defensive plays and things like that. But the point is that I think it's better to have a long and a short strategy, which is what this stuff is, than it is to always say, well, I'm not a trader, I'm just going to buy it and hold it. Well, look, these are trading systems that go long and short all the time. Okay, so it doesn't matter what the market's doing. The only thing that you would have to do is to look at these trades every few days and go back and forth. But it's not like something where you have to sit there on a minute-to-minute basis and watch it. And it's not like that. It's a portfolio. But I would just be careful about it. I mean, You know, some people feel like the bond is a good buy right here because if the S&P goes down, fine. And it might be a flight to quality right now. But the point is, but if you have the double lunar cycle, you don't really need to worry about if it's going up or down. You just follow the system along, and that's how it works out. So that's what I would say. I would say start with the double lunar cycle, and then you can combine them with the portfolios. And I will continue to provide these portfolios. Where do you find the double lunar cycle? You can find it in the monthly newsletter or the daily charts of the gold member section. So the monthly newsletter, everybody gets this every month. There's a double lunar cycle there where you can go and you can look at what it looks like. I'll show you an example of how that looks right now. I'm going to go to the website, and I'm going to go to the cryptocurrency section and show you what, right, we can go to metals, show you what it looks like. So I'm going to go here and show you, this is the metals closing bell here. So like this is an example of metals. Each week I show you something different, but this is metals. So we log on to metals. And so each time you log on to the website, you see these buttons on the site, and each button is something different. And this button is the newsletter. So if you click this, you'll get the newsletter. So this is the metals newsletter. So this is there's a table of contents, and so you can in these table of contents you can click and go anywhere that you want. So let's say that I want to go to silver and I want to go to the medium term cycles, which is the double lunar cycle. It takes me right there. So this works in a PDF. You just click on that link on the table of contents. It takes you to the day that you want to go to. So again, I'll go back again. This is the metals newsletter. If you scroll down in Adobe PDF or any PDF reader, there's a table of contents here. Let's say I want to go to silver medium term cycles, which is the double lunar cycle. I click on silver like this, and then it takes me to the double lunar cycle. These are the actual signals. So you have these at the beginning of the month. You can also just scroll down too. So for example, we look at gold. We look at this longer term chart on gold. We look at the solar cycles, and we look at many different patterns. But this is the double lunar cycle here. So you have this information before the month starts. It's in the newsletter. And then those are the signals that I showed you on the portfolio manager that combine together. This is an example of each week of the month. I tell you statistically, these are the weeks of the month that are strong, and these are the weeks of the month that are weak. This is the highest chance of a reversal this week. This is the lowest chance of a reversal this week. These are the statistics, the percent chance that it's up for this week of the month, the percent chance that it's going to reverse. And so we have this in the metals newsletter. We have this for copper, silver, gold, and platinum. So depending on what you want to look at, they're all there to take a look at. Okay, so that's an example of the newsletter. Now I'm going to go over here back here to the website because people have questions about this all the time. Where do I find this? So I'm just going to show you. So the closing bell. Now this works on your phone too. So this is a mobile. This is meant to work on a mobile setup. So these buttons will show up on your phone too. So I'm going to go here to the closing bell. So I'm going to click this, and then this shows up, and this is what you see each day. Okay, so copper, you can see we have these different Fed uses here. Copper, the Fed use is down. Gold and silver and gold, the Fed use is up. I said we might be at a short-term bottom right now. This is what you would get on a daily basis. You come into here, it shows you the chart with the double lunar cycles here. You have the Fed juice here. And by the way, we have this for over 25 different symbols. I'm just showing you one set here. These are the daily statistics. It shows you the best day to buy copper, the worst day to buy copper, or the best day to sell copper, the day that it makes its biggest runs, you see here, and then the highest chance of reversal. And then you go through here, and you can see how each one does. Okay. Also, I have here the double lunar cycles here. We're coming to the end of the month here right now, so I'll go ahead and show you this, but this is on here too. So this is on the closing bell too. So you could see the double lunar cycle, like if you go back here on copper, you could see it here in the newsletter, or you could go to the closing bell and you can see it here. So different ways. This is recent videos. These are daily statistics. These are weekly statistics. So that's just an example of how you would find it, because people do ask me that question. So how do you find that stuff? That's how you find it. So just an example there. Fed juice I just showed you. Where do you find the Fed juice? You find it on the closing bell. So the closing bell again was that one I just showed you. And yeah, I think that's basically it. Got the question people do ask me about the taper. When will the market start to feel it? We did talk about this, that I think once we get into the second and the third month, the markets are really going to start to feel it. So there's going to be a lot of issues here going forward. Now, I do get a question that people ask me. They say, "Well, what will happen if the COVID situation becomes worse? Will the Fed reverse course?" I think the Fed at some point obviously will try to help out if this becomes a big problem. But the bigger problem is now that we have inflation, and the many of these other countries are ahead of us on the interest rate hikes right now. So I don't think it would be like an immediate 180. I still think they're going to have to do this, and then I think they could ramp it back up. I think they're almost better off doing this now, and then they could have some more bullets to go further. So, all right, that's it, guys. So for this video, thanks everybody for showing up on a holiday weekend. I know everyone's doing their own stuff, but we had a pretty good turnout today for a holiday weekend. And if you guys need to reach me again, you can reach me at shane@wolftraderfutures.com. And if you guys want to check out any of these services, you can head on over to wolftraderfutures.com, plans, pricing, and it will show you the different trials that we have. And try it out for a week. I mean, look, even if you get the week trial, you still get the month of the double lunar cycle. You can take a look at that. I've showed you how successful these things are becoming. We will have the portfolios showing up. So on the website, you're going to start to see, if you combine copper, silver, gold, here's what it does on the Fed juice. If you combine it on the double lunar, here's what it does. So I think it's worth your while to check it out. I believe very, very strongly in what we do here. I focus on the data specifically. I follow the data, and then we build our trading systems out. And I built everything up here from scratch. I built every single system. I write all the code for all of these different optimizations. And so we've built a whole infrastructure and a whole technology on how to, not just how to create the signal, but how to optimize the signal to get you guys the best outcomes. And I think we're getting better each week. I mean, that's the focus of what we're trying to do here. Website, wolftraderfutures.com or www.fedjuice.com. And YouTube, Wolftrader Futures, and then Twitter at Wolftrader FUTU1. Again, I highly recommend that you head on over there to check out the Twitter. And for those of you who are subscribers, we will have an update tomorrow. The new newsletter is coming out next week. There is a ton of astrological stuff going on this month. I mean, the big event last month was the eclipse. I think we covered that pretty good. But next month, guys, next month, there is some really important things, developments coming, and they're all kind of clustering around the same part of the month. So thanks, everybody. I think with that, we're going to sign out here. Have a great weekend, everybody.